There is a kind of trader I have seen again and again, and I have been that trader myself more times than I care to admit. He is not foolish. He is not reckless in the obvious sense. In fact, he is often intelligent, observant, and serious about the market. And yet, he is always just a little bit wrong, almost right on direction, almost right on timing, almost paid, almost successful. Tell me, have you ever lived in that narrow space between being right and being rewarded? The market is a hard teacher because it does not pay you for being close. It pays you for being correct at the right moment and for staying correct long enough. Being almost right is the most expensive condition a trader can live in. It drains capital, confidence, and clarity all at the same time. And the cruel part is this: near misses feel like proof that you are improving, when in truth they often signal a structural flaw that has gone uncorrected. I learned early that the market does not care for opinions. It cares for timing. You may see a stock is undervalued, or that a trend must soon turn. But if you act before the market is ready, you are not early. You are wrong, and wrong does not need to be dramatic to be deadly. A series of small losses, each justified by, "I was right, just too soon," will do the job quietly. How many times can a man afford to be early before early becomes broke? The trader who is always almost right usually enters before confirmation. He sees the picture forming and cannot wait for it to finish. He fears that if he waits, the move will leave without him. That fear has ruined more traders than bad analysis ever did. The market has no obligation to include you in its move, and it does not reward impatience with mercy. When you enter too soon, you are not trading the market. You are trading your need to be involved. I used to tell myself that my early entries showed courage. In truth, they showed insecurity. I wanted to prove that I could see what others could not. I wanted to be first. But the market does not reward first sight. It rewards right action, and right action almost always feels dull at the moment you take it. Does that surprise you? The correct trade rarely feels exciting, because excitement is the emotion of anticipation, not confirmation. Near misses are dangerous because they build a false narrative. The trader says, "My analysis was correct," and perhaps it was, but analysis without execution discipline is nothing more than intellectual vanity. The market does not pay for clever thoughts. It pays for alignment. Alignment between trend, timing, and behavior. If you miss again and again by a small margin, the problem is not the market moving too fast. The problem is you moving too soon. Another flaw hides beneath these near misses, and it is more personal. The emotional need to prove something to the market. This need is subtle. It does not announce itself loudly. It disguises itself as confidence, decisiveness, and conviction. But underneath, it is a form of argument. The trader is not waiting to see what the market will do. He is telling the market what it should do. Have you ever noticed how quickly the market humbles a man who tries to lecture it? When a trader needs to prove he is right, he cannot wait for confirmation. Waiting feels like doubt, and doubt feels like weakness. So he acts. He commits capital before the market has committed direction. And when the trade fails, he does not fully accept responsibility. He says, "The timing was off," as if timing were a minor detail. Timing is the trade. Direction without timing is a theory, not a position. I learned through loss that the market speaks clearly, but only after it has finished speaking. The dangerous trader interrupts. He jumps in mid-sentence and then complains that the message was unclear. Confirmation is not a luxury. It is the market's signature on your idea. Without it, you are trading on hope, no matter how logical your reasoning sounds. The almost right trader also tends to overtrade. Each near miss creates urgency. He feels close, so he presses harder. He takes the next setup with less patience, the next entry with less structure. He believes the market owes him a win because he has been correct in spirit, if not in result. The market owes no one anything. It is a mirror, and it reflects your discipline or your lack of it with perfect honesty. There is also a money lesson here, and it is not separate from trading. Capital must be respected before it can grow. Every premature entry is a small act of disrespect toward your capital. You are risking money before the odds have aligned, and that habit does not disappear as size increases. It compounds. The man who is careless with small trades will be reckless with large ones. Do you think wealth is built by repeating behaviors that barely survive? I came to understand that missing a trade is not a loss. Entering too early is. The market will always offer another opportunity, but it will never refund poor discipline. The trader who waits feels unproductive, even foolish, while waiting. But that discomfort is the price of survival. Most men would rather feel active than right. The market takes advantage of that preference relentlessly. When you study your trades, do not only ask whether your idea was correct. Ask whether your behavior was correct. Did you wait for the market to agree, or did you rush to be validated? Did you enter because conditions were present, or because you were tired of watching? These questions are uncomfortable, which is why most traders avoid them. But avoidance shows up on the equity curve sooner or later. The hardest lesson I ever learned was that being right too early is indistinguishable from being wrong. The tape does not remember your intention. It records only your action. An action taken without confirmation is action taken alone. The successful trader is never alone. He moves with the market, not ahead of it, not against it, but alongside it, when it is ready. And yet, knowing this does not make it easy. The market tests patience in a way few other pursuits do. It offers partial truths, incomplete patterns, tempting setups that look ready but are not. The trader who survives learns to sit on his hands and listen. He learns that silence is not wasted time, it is preparation. He learns that proving something to himself is far more important than proving anything to the market. Because in the end, the market does not reward effort, intelligence, or desire. It rewards alignment. And alignment only comes when the trader is willing to wait until the market stops whispering and starts speaking clearly, even if that means watching opportunity after opportunity pass without action, even if that means enduring the quiet doubt that asks whether this time will be different, whether this time waiting will finally matter, whether restraint itself might be the edge he has been searching for all along. Being early is indistinguishable from being wrong, and the market makes no effort to explain the difference to you while you are losing money. It does not pause to acknowledge your insight or reward your anticipation. It only responds to your position. If you are early, your capital is exposed without support, and that exposure carries the same risk as a bad idea. Have you ever noticed how the market treats an early entry and a foolish one exactly the same way? A trader often comforts himself by saying he was right, just early, as though timing were a minor inconvenience instead of the entire business. But the market is not a debating hall where partial credit is given. It is a settlement system. Either you are positioned when the move begins, or you are not. If the move has not started, your opinion has no value. Price does not bend to foresight. It waits for confirmation, and so must the trader who intends to survive. I learned this lesson the expensive way. I would see a stock that had been declining for weeks, and I could feel in my bones that the selling was near exhaustion. The volume would thin, the reactions would shorten, and my mind would rush ahead to the inevitable turn. I entered before the turn came, convinced I was buying at the lowest levels. But the market did not care what I believed. It continued lower, slowly enough to keep hope alive, but steadily enough to grind down both my position and my confidence. Tell me, what good is being correct about direction if the timing breaks you before you ever see the reward? The problem with early entries is not only financial, it is psychological. When you enter before confirmation, you place yourself in a position of defense from the very beginning. You are no longer observing the market. You are defending a belief. Every small downtick feels like an attack. Every pause feels like a promise. Your judgment becomes compromised because your money is already at risk. The market has not committed, but you have, and that imbalance puts you at a disadvantage you may not even recognize. Many traders confuse patience with hesitation. They think waiting means doubting themselves. In reality, waiting is the highest form of confidence a trader can have. It means he trusts that when the market is ready, it will show him. It means he does not need to predict the future, only to respond when the present becomes clear. Why should a man risk his capital to prove he is clever when the market will eventually provide proof on its own terms. Being early also creates a dangerous habit of rationalization. A trader learns to excuse losses by blaming timing instead of behavior. He tells himself that his method works, but his execution needs minor adjustment. This keeps him from addressing the deeper issue, which is impatience. The habit of acting before confirmation seeps into every decision. Position size increases, stops loosen, and discipline erodes, all under the belief that the trader is fundamentally right. The market punishes this belief quietly, through a series of small losses that feel manageable until they are not. There is another cost to being early that few traders calculate. It ties up capital. Money committed too soon is money unavailable for better opportunities. While the early trader is trapped in a losing or stagnant position, the market may offer clean, confirmed setups elsewhere. But the early trader is emotionally and financially occupied. He watches those moves from the sidelines, telling himself he cannot exit now because the original idea is still valid. Do you see how being early not only risks loss, but also steals opportunity? The seasoned trader learns that the market moves in stages. First comes the idea, then the evidence, and finally the opportunity. Most traders try to act at the idea stage because it flatters the ego. Few are willing to wait for evidence because it requires humility. But humility is cheaper than drawdown. Evidence means price has begun to move. Volume has confirmed intent, and the market has shown its hand. Entering at that point may not feel like catching the bottom or the top, but it feels stable. Stability is where profits are built. I came to understand that the market is never late. It arrives exactly when it means to. The trader who complains about being late is usually mourning the loss of an imaginary advantage. He wanted the perfect entry, the lowest price, the highest point of return. But perfection is a fantasy that leads men to risk real money on unconfirmed conditions. The market rewards those who accept less than perfect entries in exchange for greater certainty. Being early often stems from fear. Fear of missing out. Fear of watching a move unfold without participation. This fear pushes traders to act before they should, but missing a trade does not harm an account. Entering the wrong one does. The trader who survives long enough learns that boredom is not an enemy. It is a filter. It keeps him out of trouble when nothing worth doing is happening. There is also a lesson here about wealth beyond trading. Capital grows through preservation first, expansion second. The man who constantly risks his money on unproven situations is not building wealth. He is gambling on validation. Wealth favors those who wait for favorable conditions, who deploy resources when the odds are clear, and who accept inactivity as part of the process. The market teaches this lesson daily, but only to those willing to listen. When I finally stopped entering early, my results changed, not because my ideas improved, but because my timing aligned with reality. I waited for the market to move first. I let it prove me right before I risked my money. This did not make trading exciting. It made it quiet. And in that quiet, losses became smaller, decisions became clearer, and patience became a tool rather than a burden. The market will always tempt you with the promise of being first. It will show you setups that look ready, that feel urgent, that seem obvious in hindsight. But hindsight does not pay commissions. Discipline does. Being early may satisfy the ego, but it punishes the account. The trader who understands this stops trying to impress himself and starts trying to protect his capital, knowing that survival is not earned by clever anticipation, but by waiting until price, time, and behavior align, and by accepting that until that alignment appears, the safest position may be no position at all, even when every instinct urges action, even when the chart appears to whisper that now is close enough, even when the desire to participate grows stronger with every passing bar, even when the hardest part is doing nothing and trusting that restraint itself is not a delay, but a decision still unfolding. Near misses reinforce bad habits, not skill, and this is one of the quietest dangers in trading. A clean loss can teach a trader something if he is willing to look at it honestly. A near miss, however, does something more subtle. It convinces him that he was close enough to be right, and that belief is far more damaging than being plainly wrong. Have you ever noticed how a trade that almost worked stays in your mind longer than one that clearly failed. The market has a way of rewarding clarity and punishing ambiguity. Near misses live in ambiguity. The trader sees price move in his intended direction, maybe even strongly, but not at the moment he needed it to. Or it moves just after he exits, or just before he enters. These experiences create the illusion of progress. He feels he is refining his edge, sharpening his instincts, getting closer to consistency. In reality, he may be repeating the same structural mistake over and over, with just enough confirmation afterward to keep him from changing. A near miss does not feel like a mistake. That is why it is so dangerous. It feels like proof that your thinking is sound. The trader says, "If only my entry had been slightly better." Or, "If only I had held a bit longer." But the market is not asking for "if only." It is asking whether your behavior aligns with its structure. If your timing repeatedly places you just outside the move, the issue is not precision, it is impatience. I have seen traders build entire identities around being early but right. They wear it like a badge of intelligence. They speak of foresight, of seeing what others cannot yet see. But the market does not reward foresight without discipline. It rewards execution. And execution requires waiting for conditions, not predicting them. When near misses pile up, they often signal that a trader is acting on anticipation instead of confirmation. That habit does not improve with repetition. It hardens. Each near miss strengthens the emotional attachment to one's method. The trader becomes defensive of his approach because it feels validated. He points to the chart and says, "See, it went exactly where I thought." But he ignores the fact that he was not positioned when it mattered, or that he was forced out by normal volatility because he entered too soon. Do you see how the market can move exactly as expected and still teach you the wrong lesson? Near misses also distort risk perception. Because the trader feels close to success, he is more willing to overlook small rule violations. He widens stops slightly. He enters a bit earlier next time, convinced he needs to get in sooner. He adds size, believing the edge is already proven. These changes feel logical in the moment, but they are built on a false foundation. The habit being reinforced is not patience or discipline, but urgency. The mind is especially vulnerable to this pattern because humans are wired to learn from near wins. In gambling, near wins are known to be more addictive than losses. Trading is no different. The chart almost does what you expect, and your brain treats that as encouragement. It releases confidence without delivering profit. That confidence pushes you to repeat the same behavior, hoping the next attempt will align perfectly. But the market is not a slot machine. It does not pay out for persistence. It pays out for alignment. Another problem with near misses is that they prevent honest self-assessment. A trader who is consistently wrong must eventually confront his method or abandon it. A trader who is consistently almost right can avoid that reckoning indefinitely. He stays busy adjusting minor details while the core floor remains untouched. He tweaks indicators, time frames, entries, exits, all while ignoring the central issue. He is acting before the market confirms his idea. Near misses also create emotional fatigue. Each one requires mental energy to process. The trader relives the chart, replays the decision, imagines how close he was. This drains focus and increases frustration. Over time, frustration leads to forcing trades. The trader becomes less selective because he feels owed a win. He has been close too many times, he tells himself. But the market does not recognize effort or frustration. It recognizes only price and behavior. There is a money lesson buried here that extends beyond trading. In any form of wealth building, progress that looks close but rests on weak structure is dangerous. A business that almost breaks even, an investment that almost works, a strategy that almost delivers consistency can trap a person for years. Resources get committed to something that feels promising but never fully proves itself. The opportunity cost is enormous. Capital, time, and focus are all spent maintaining something that should have been corrected or abandoned. The disciplined trader learns to treat near misses with suspicion, not comfort. He asks hard questions instead of celebrating being close. Why was I not in the move? Why was I stopped out before it began? Why does this keep happening? These questions are uncomfortable because they challenge the ego. They suggest that something fundamental needs to change. But discomfort is often the entry price of improvement. One of the most difficult shifts I had to make was to stop taking pride in being early. I stopped saying, "I saw it coming," and started asking, "Did I act when the market acted?" That change removed many near misses from my record, not because the market became easier, but because I became stricter. I waited for price to do something first. I let go of the need to be clever. The trades I missed no longer bothered me, because missing was no longer confused with failure. Near misses also reveal an emotional need to stay engaged. Many traders cannot tolerate watching without participating. They feel useless when flat. Near misses allow them to feel involved without being rewarded. This is a dangerous compromise. Trading is not about constant involvement. It is about selective involvement. The market does not offer opportunity every day, and pretending otherwise leads to repeated frustration. If you study your history and see a pattern of near misses, do not congratulate yourself. Study it like a warning. Patterns repeat because behavior repeats. The chart may change, the market may change, but impatience expresses itself the same way every time. It enters too soon, exits too soon, or sizes too aggressively. Near misses are the market's way of showing you that your idea may be sound, but your execution is not aligned. The trader who grows out of this phase learns to value confirmation over anticipation. He accepts that being late is safer than being early. He understands that a trade missed costs nothing, while a habit reinforced costs everything. He begins to see that skill is not proven by how close you come, but by how consistently you act when conditions are truly present. And as that understanding deepens, the need to chase closeness fades, replaced by a quieter focus on structure, patience, and the discipline to wait even when the setup looks familiar, even when the urge to act feels justified, even when past near misses whisper that next time will be different if only you move a little faster, a little sooner, a little less cautiously, despite the evidence that speed without confirmation has already taught you exactly what it leads to. Confirmation is the market's permission slip, and without it you are trading on assumption, not fact. The market does not object when you act without permission. It simply lets you proceed and then sends you the bill. Many traders never understand this distinction. They believe conviction is enough. They believe analysis earns them the right to participate. But the market recognizes only one form of authority, and that authority is price itself. Have you ever noticed how quickly confidence collapses when price refuses to confirm it? I learned early that the market is always right, not because it is intelligent, but because it is final. You may think a stock should move. You may believe it must move, but until it does, your belief has no standing. Confirmation is not about certainty of outcome. It is about alignment of forces. It is the moment when the market stops hinting and starts acting. Without that moment, you are guessing, no matter how refined your reasoning appears. Most traders resist waiting for confirmation because it feels like surrender. They fear that waiting means giving up an edge. They want to enter before the crowd, before the move becomes obvious. But the idea that obviousness removes opportunity is one of the most expensive misconceptions in trading. The market does not pay you for secrecy. It pays you for correctness, and correctness requires evidence. Why should you risk capital before the market has shown its intent? Confirmation often arrives quietly. It may be a break of a level that has been tested too many times. It may be a change in the way price reacts to bad news. It may be a shift in tempo, a tightening followed by release. These are not dramatic events. They do not excite the impatient trader, but they are the market's signature. They say, "No, you may proceed." Acting before that signature is forged consent. The trader who ignores confirmation is usually driven by the need to predict. Prediction flatters the ego. It makes a man feel intelligent. Confirmation requires humility. It requires admitting that the market knows more than you do in the moment. That admission is difficult, especially for the thoughtful trader, but the thoughtful trader who cannot wait becomes a thoughtful loser. The market does not reward thought unless it is paired with discipline. I have watched traders enter positions simply because price was near a level they believed was important. They assumed support would hold because it had held before. They bought weakness without waiting to see whether weakness had finished. When the level broke, they were surprised, as if the market had violated an agreement. But there was no agreement. They had acted without permission. Confirmation would have told them whether buyers were present. Without it, they were blind. Confirmation also protects you from yourself. When you wait for the market to act first, you reduce emotional interference. You are no longer forcing a narrative. You are responding to one. This changes everything. Losses become easier to accept because the trade was taken on evidence, not hope. Wins become easier to manage because you entered with structure, not urgency. Do you see how confirmation is not only a market signal, but a psychological anchor? There is a common fear that confirmation means entering late. This fear comes from a misunderstanding of how trends work. Major moves do not begin and end in a single bar. They unfold. The first confirmed move is rarely the last. The trader who waits sacrifices the illusion of perfection for the reality of probability. He may not catch the bottom, but he avoids the endless series of false bottoms that trap the impatient. I remember watching stocks that I was convinced were ready to turn. I would enter, watch them drift lower, exit in frustration, only to see them rally weeks later. Each time, I told myself I had been right all along, but that belief did not change the fact that I had lost money. Eventually, I realized that my ideas were irrelevant until the market validated them. The rally that came later did not vindicate my early entry. It exposed it. Confirmation also teaches restraint in position sizing. When a trader waits for permission, he tends to size more rationally. He is not trying to compensate for uncertainty with aggression. He knows the trade has structure behind it. This does not eliminate risk, but it contains it. The trader who enters without confirmation often sizes emotionally. He feels the need to make the trade matter because it is based on belief rather than evidence. There is a broader lesson here about capital and wealth. Capital should be deployed when conditions justify it, not when impatience demands it. Wealth is built by selective aggression, not constant activity. The market rewards those who wait for favorable conditions and then act decisively. It punishes those who act constantly and hope conditions will follow. Confirmation is the dividing line between these two approaches. Many traders confuse confirmation with certainty. They wait for absolute proof and end up paralyzed. That is not confirmation. Confirmation is not about eliminating risk. It is about reducing unnecessary risk. It is about ensuring that the market is moving in the direction you intend to trade. Beyond that, uncertainty always remains. But uncertainty after confirmation is manageable. Uncertainty before confirmation is reckless. The market offers countless opportunities to test your patience. It will show you partial setups, almost breakouts, near reversals. These are invitations to act without permission. The disciplined trader declines them. He waits for completion. He understands that incomplete information is more dangerous than no information at all. He also understands that doing nothing is an action, one that preserves capital and clarity. Over time, waiting for confirmation reshapes the trader's mindset. He becomes less concerned with being right and more concerned with being aligned. He stops arguing with price and starts listening to it. His trades become fewer, but his losses become smaller. His confidence no longer comes from prediction, but from process. And that kind of confidence is quieter, steadier, and far more durable. The market does not rush. It does not care about your schedule or your need for action. It will move when it is ready, and when it does, it leaves evidence behind. The trader's job is not to anticipate that movement perfectly, but to recognize when it has begun. Confirmation is the market saying it is ready. Until then, every trade is a request made without approval, every entry a signature forged in hope, every position a reminder that acting without permission may feel decisive in the moment, but decisiveness without confirmation is nothing more than impatience wearing the mask of confidence. Direction without timing is intellectual vanity, and the market has a particular way of exposing it. A trader may correctly identify where price is likely to go, yet still lose money consistently. This confuses him, because he believes correctness should be rewarded, but the market does not reward ideas, it rewards execution. Execution lives in time, not in theory. If you act at the wrong moment, the right idea becomes useless. Have you ever wondered why being right so often can still feel like losing? Many traders take pride in their market opinions. They study charts, macro conditions, sentiment, and structure, and they reach logical conclusions. There is nothing wrong with analysis. The danger arises when analysis becomes an end in itself. The trader begins to value his conclusions more than the market's response to them. When price does not move as expected, he argues with it internally. He says the move is delayed, manipulated, or misunderstood by others. But the market does not delay to accommodate opinions. It moves when supply and demand shift, not when a trader finishes his reasoning. Timing is not a secondary detail. It is the trade. Direction answers the question of where price might go. Timing answers the question of whether you can stay solvent long enough to benefit. Without timing, direction is just a forecast, and forecasts, no matter how thoughtful, do not pay commissions or protect capital. The trader who ignores timing is like a man who knows which train to take but arrives at the station after it has already left. I learned this lesson after being correct far too often, without profit.